Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Nina Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Nina Mishra. My guest today is Tracy Reinick, Zacks Senior Equity Strategist and editor of Zacks Value Investor. We're talking about investing like Warren Buffett, one of the greatest and most respected investors of all time. Tracy, welcome back. I'm so excited about this topic.
Yeah, me too. It's always fun when we get together because there's always a lot going on the ETF side, and especially with, what Buffett is doing because he's back in vogue again.
Yeah.
He's in. Yeah.
Yeah, so Berkshire actually reported earnings last week, right? And the Class's stock hit an all-time high. And looking at the longer term period, it is up more than 25,000 times from around 20 when Buffett took control of the company in 1965. That is according to Barron's. So obviously all investors would love to emulate Buffett's investing strategy, but it's easier said than done. We know that. And recently, a new ETF called Buffett ETF launched in Europe, and some people wondered why this type of product didn't exist earlier, because ETF industry is very innovative. You think of an idea and you have an ETF for that. And fund providers are constantly experimenting with new products and just to see what resonates with investors. But there was no Buffett-like ETF earlier. So we will talk about that European ETF in a bit, and I think Buffett is not going to approve of that product. But let's start with Buffett's investing strategy. And in fact, let's start with what you called early era Buffett, because that is when he achieved a lot of success. All of those returns that we mentioned earlier most of them came earlier during his career. So tell us about early era Buffett and what kind of investing strategy he liked when he was following Ben Graham's value investing approach, right?
Yeah. When he first started off, it was very much a strict value type of investing. So that meant kind of the boring industries, a lot of the big industrials, but also insurance. That's when he first started, when he was very young, interested in Geico. And there's that famous story where he, got into the Geico offices or something, and he ended up talking with like the CEO or whatever. But that created, thing in his type of investing style where he saw opportunities that no one else was really noticing. And that's what he dove in on in the early years. And then there was a big growth stock boom in the 1960s. And he felt like he was pretty much priced out. There wasn't a lot of these, big kind of boring companies that were trading at good valuations anymore. So that's when he kind of threw in the towel when the Nifty 50 from around 1970 or so, where anything went. It's kind of similar to what we just saw during the pandemic, where it didn't matter what you paid for the company, what the valuation was. So if it's trading at 50 times, you didn't care because you were buying the growth aspect of it. But he, as a value investor, still did care. So he did throw in the towel on the partnership then, gave back a lot of money to people, but then launched Berkshire Hathaway during that period. And then in the 1970s, that was when value investors really reigned. It was a bear market, but there's always a bull somewhere, and that bull was in the value stocks. So he did talk about, like, by the mid 70s when he was giving interviews about being like a kid in the candy store because there was valuations on the overall market were low and you could get a lot of good quality names at single digit PEs back then. So he was still deploying into good, sound businesses, which again, back then usually meant, good brands and obviously the good free cash flow and long-term trajectory on those businesses. So it wasn't until I think around the 1980s is when he started getting really into the bigger brand picks like the Cokes. But that kind of goes to, it was, cheap when he bought it, and he was a user of the product and still is apparently. He used to drink like 5 or 6 Cokes a day. And so it was kind of like buy what you know. And that was the old Peter Lynch phrase. But Buffett also does sometimes deploy that buy what you know. But you can see from the Berkshire portfolio now that there's still a lot of those same trends from the early years. He still owns insurance. He owns Geico outright now. He still owns a lot in the financials like American Express, but the industrial side is still big in his portfolio. And, he's got the railroad now. That's like the old economy, if I ever heard it, to own your own railroad. But those have served him well and can still serve all investors well because we're still transporting stuff on the rails.
Right.
Yeah.
Right. So as you mentioned, in his early years, he was strictly a deep value investor. And I think he once said that he liked to buy beaten down companies, which he called cigar butts. But after a few years or maybe a few decades, he was looking for companies which were wonderful companies, which he called wonderful companies trading at fair prices. And he did not invest in technology for a long time. And he mentioned that it was because you also mentioned that he liked to buy what he understands. And initially he said that he did not understand technology stocks very well. So probably that's why he avoided investing in technology companies. So in the last few years, we have seen a lot of investments in technology companies too. Apple is one of the biggest holdings in his equity portfolio, and there's a lot of investments by his lieutenants too. So tell us how the Berkshire's investing strategy has evolved over time. Have you seen more investments in growthier or riskier stocks, not exactly beaten down value stocks? Have you seen more trading also? Because earlier he was holding companies, holding stocks for decades. But lately we have seen some trading like in and out of certain stocks like TSMC. So tell us about this evolution.
Yeah, some of it is from the lieutenants. So we don't really know what they own. Well, sometimes we know because he'll tell us, like Amazon. That was not a stock bought by Warren. It was bought by one of the lieutenants. He never said which one, but they have their own separate portfolios. They were given a set amount of cash and they were told, you can do whatever you want with it. I'm not going to really interfere, except he did interfere when the pandemic hit and they owned some of the airlines, and he did make them sell. He wanted out of that trade when the pandemic hit. But that's the only time that we know that he ever interfered in what they were doing. So it gets a little bit trickier because we don't know, and their investing styles are slightly different, even though they're both value investors as well. So they used to own RH, which is formerly known as Restoration Hardware. They owned that for a couple of years, but pretty clear that that's probably not Warren Buffett, even though he does own a furniture company in Omaha. But that particular stock we don't think was Warren. That was one of the lieutenants. They did sell out of that position, so they're no longer in it. But yeah, you do see more trading, but that could be more by the lieutenants. And yeah, I'm not sure why he's seemingly wanting to trade more. Like, for instance, on some of the energy positions that they've entered into in the last couple of years, there's been quite a lot of actual almost trading like behavior where they buy one quarter and then sell the next. But then Buffett went all in on big investments in both Chevron and Occidental, but they still continue to sell little bits and pieces of Chevron, a little bit each quarter. I'm not sure what that's about, because that kind of goes against Buffett's own views, unless that is owned by one of the lieutenants. So they might decided, hey, we want to get out of this. Warren owns this other big chunk in it anyways, so I'm going to deploy this into something else, because Warren still controls the rest of the cash, Berkshire, from what we know. So the lieutenants might be a little more, handcuffed on what they can do. Yeah. So then they have to sell something like we would have to make room to bring some cash in if they want to buy something else that they consider more attractive. So that could be why there's more trading, just because there's now 3 managers in that portfolio, not just the one. But for the most part, on a lot of the big positions, it still is, buy and hold for relatively long periods of time, especially given what the average investor is now doing. Most of us are only owning for 3 months. So even if we own, 2 or 3 years, that would probably seem like a real long period of time. And Buffett, on most of the positions he has, unless something is wrong with it, he just wants to get out, like he did with the airline stocks. But he is still holding, 10 years or more with a lot of them, if you actually look at the portfolio. So,
yeah, that was his signature style of investing, and that is why some of the recent transactions surprised me also. For example, TSMC, which he called one of the best managed companies and one of the most important companies in the world, and I think they held the stock just for a quarter or so.
One quarter, yeah.
Though he was asked about it, and he mentioned that it was because of geopolitical risk associated with TSMC.
Right.
So let's talk about their current holdings. I know that Apple accounts for almost half of the equity portfolio now. What else? Tell us what else they hold, what businesses, and what the equity portfolio holds currently.
Well, after you get Apple out of there, it's a lot of energy. It's Chevron and Occidental, and he does keep adding to the Occidental position. It's American Express. It's still Coke. Coke is still up there, and it doesn't get that much discussion. And I saw somewhere that the portfolio is generating about $5 billion a quarter in dividend payments right now, because a lot of these companies are kind of the old school and they pay the dividends. Even Apple pays the dividend. But, Chevron, you're almost getting a 4% yield on that one, and they have a big position in it. So he has cut back on a couple key areas like the banks. That's really one of the areas he was way overweighted for years and years, especially coming out of the Great Recession. He did have a big position in Bank of America, which he still owns, and that's in the top 5 of the positions. But I think he thought, like a lot of us, that once the worst of it was over on the banking side after the Great Recession, that sector and those companies and stocks would have a big rebound, but it hasn't really happened yet. I mean, they're definitely off their lows, but I think he thought, as many of us did on the value side, that the banks would be where you would find the next, kind of bullish type market, but it didn't happen. And then he ended up, getting out of a lot of the banks, because at one point the banks were, a huge chunk, almost as big as Apple in the portfolio at one point. But now it's pared way back. So,
And he has a lot of cash. Berkshire has how much? Close to 150 billion in cash currently.
Yes.
And since cash is not unattractive as of now, he's investing in T-bills and earning close to 5% there, which is not bad at all. So let's go back to that ETF that I mentioned earlier.
Yeah.
So it is called the Buffett Growth ETF. The ticker symbol is BUFF, BUFF. And according to its website, it seeks to invest in stocks and funds that relate to Warren Buffett's investment career, going back to his early days focus on small caps to his present days investment in quality companies at fair prices. So there's certain, I have some issues with this particular ETF. So if you look at the holdings, Berkshire share ETP, the single stock ETP, that is about, I think, 80% of the portfolio. And that's a leverage, 2 times leveraged single stock ETP on Berkshire Hathaway stock. So there's the problem. I know that Buffett doesn't like leverage, so he's not going to approve of that. Then if you look at the fees, it's pretty high. Let me take a look. I think it's 1%. The expense ratio is 1. And on top of that, it also charges a high watermark performance fee of 10%. So this is something which Buffett doesn't like at all. He likes investing in low-cost, very simple index funds like S&P 500 index fund. So we'll talk about those funds in a bit. But when you looked at the holdings of this particular ETF, what were your thoughts?
When you brought up the fact that, why haven't we had a Buffett-like ETF before? Because that would make some sense, right? We've talked about all the crazy ETFs before on the various podcasts, and you would think this one would have been around like years and years ago. But then when you stop to think about it, why do I really need an ETF that's investing like Buffett when I can just buy Berkshire Hathaway? Like just buy that stock and just get the actual company itself. And then we're getting what Buffett is doing, because Berkshire Hathaway basically it's a huge conglomerate, and it is a basket of all these various businesses, plus the stock equities. People forget that it actually does own an actual railroad, and it has Dairy Queen and all these other businesses within there. So, most of the investors who want to invest like Buffett, unless they buy individual stocks to get kind of like how he invests, or some of his actual holdings, you can just go buy those, then why not just buy Berkshire Hathaway? And then you avoid, like you just mentioned, all the fees and, all of that stuff on this other ETF. So I can kind of see now, why would we want to have it?
Yeah, and if you look at some of the other holdings too, it holds Netflix, Tesla, Nvidia, and Apple. Apple is fine because, Berkshire bought Apple, but they bought it when it was still a value stock. I don't think Apple can be called a value stock now. And I'm not very sure whether Buffett or Berkshire would invest in companies like high growth companies like Nvidia, like Tesla, like Netflix.
Right. I think no. I think the answer would be no, not with those cash flows.
Yeah, right.
Yeah.
And he never invested in Tesla. And in fact, he has invested in a Chinese company, EV company, BYD.
Right.
And that was years back when that stock was also cheap. Lately, I saw that they have been booking profit on that particular BYD holding. So this doesn't look very much like what Buffett would hold, what he would like to purchase. So,
and it is also interesting too that they're kind of marketing it as what Buffett would have held in the early parts of his career, like the small caps and stuff, which is true. He loves the small caps. That is what his bread and butter was originally. He can't buy them as much, or if any, anymore, because Berkshire's just too big. He has too much cash. It's like almost worthless for him to buy it now. But yet they own Netflix and Tesla and Nvidia and Apple in it, which are not small caps. So I don't get it.
So let's talk about creating your own mini Berkshire portfolio. So the easiest way would be to buy the Berkshire Hathaway stock. Apart from that, if you want to buy some stocks that Buffett would have liked early in his career, then what kind of stocks come to your mind? Are there some stocks that you like and investors can take a look at?
Yeah, I'm not sure. Well, he probably would have bought some of these earlier in his career,
Mhm.
if they were much smaller at the time. These are mostly larger cap companies now, but the construction side, just like those old school industrials, he still likes them. They're coming back into favor now, so investing in that kind of area is a good way to invest like Buffett, but you're getting something different than what he already currently owns. So some stocks I like are like Fastenal, ticker FAST, and they make the fasteners. They also do actually the N95s and stuff, but that was always meant for the construction industry, but then that took off during the pandemic. But fasteners still their bread and butter, and that's construction. So what is improving right now is the big infrastructure bills that have passed, the CHIPS Act. There's construction going on all over the place and will be for the next couple of years. So I still like Fastenal. I've been waiting for it to get cheaper. It is not cheap on a PE basis, but it's very well-run company with the good cash flows. I would like to see if we got another sell-off for it to get cheaper here, but it's been rallying because this whole group is, performing really well right now, and the outlook is good. Another one that I do like a lot is MasTec. They just got crushed down in earnings because they gave a little bit weaker guidance, but still expected to see almost 50% earnings growth this year and almost 40% next year. Ticker is MTZ on that one. And that's on the engineering construction side as well. And then one that I've always liked, and it's still cheap, this would be a very good Buffett-like play, is United Rentals, ticker URI. They are the leader in equipment rentals. You often see, even just on job sites I've seen around here in Chicago, they're like building a building or something, and you can see the United Rentals logo on the side of a piece of equipment there, because equipment's expensive. Most people will rent it for these key jobs. And one thing to keep in mind, if you're looking at it, I've had a lot of people say, but Tracy, it has all this debt, because it does have a lot of debt, but that's because it has to purchase all the equipment, and that equipment is not cheap. So if you're just the type of investor where, I don't like the debt, and Buffett doesn't like debt, but on certain types of business models like energy or equipment, on the construction side, you are going to have a certain level of debt there. It's still cheap on a PE basis. It's trading around 12 times. So that's pretty cheap for United Rentals. But we're in kind of the early stages of this new construction cycle, is kind of what I see it as. And that's going to help Berkshire's portfolio. It owns like a paint company. And then also its railroad is going to be shipping all this stuff all over for the construction side. So you could go with a railroad too, like a Union Pacific. I like UNP a lot. So that's always available too. I was kind of mad when Berkshire got BNSF, because I was like, I like them. But that's been just a huge and great investment for them when they purchased that. So railroads still a big thing. Yeah.
And I understand you like an ETF that invests in small and mid-sized companies in the industrial and banking sectors. The ticker symbol is AIRR. And tell us why you like this ETF and why you find it Buffett-like.
Well, here at Zacks, John Blank, our chief equity strategist, pointed out this ETF to me a while ago. And I think we've talked about it in the past too. And the name kind of says it all. I mean, it's called the American Industrial Renaissance ETF. And I do like owning a basket of stocks that own these types of companies on the construction side, especially if they're smaller. You can't always get as good of access to those. So why not own just a whole basket of them? And it's near its highs, it's 52-week highs, but there's still, again, we're still in the early stages of the cycle. So if you are confused, like, oh, there's all these different types of construction type plays or, infrastructure, then looking at something like this ETF is a good way to go, I feel.
Yes, I agree with you. And I would like to add that S&P 500 funds, ETFs like the cheaper ones, VOO and IVV, that have an expense ratio of just 3 basis points. I think Buffett would really like them. He was actually an admirer of Jack Bogle, Jack Bogle, who was the founder of Vanguard and who pioneered indexing. Buffett really liked him. And in fact, when Bogle passed away, Buffett told CNBC that Jack did more for American investors as a whole than any other individual I have known. And we know about his famous 10-year bet, which he made in 2007, that an S&P 500 index fund would beat the returns of 5 hedge funds. And actually, he won that bet.
That's right.
So investors should definitely take a look at VOO and IVV. They are very great ETFs for holding in the core portfolio. And recently, State Street reduced the expense ratio on one of their S&P 500 ETFs. The ticker symbol is SPLG. So VOO and IVV charge 3 basis points, and SPLG now charges just 2 basis points. So that's like nothing. That's $2 for $10,000 invested, but there's not a lot of difference between 2 basis points and 3 basis points. So all these 3 ETFs are great investments in core portfolios. Another ETF that I find interesting and which Buffett may like is the MOAT ETF. The ticker symbol is MOAT. And we know that Buffett likes companies, at least earlier in his companies, he said that he likes companies with economic moats, which are like economic castles protected by unbreachable moats. So this ETF by VanEck is definitely worth a look. And as we discussed earlier, that lately in the last few years, he has been looking for quality companies trading at fair prices. So there are many quality ETFs that are worth a look. The one that I like a lot is by State Street. QUS is the ticker symbol. So this tracks an index that focuses on quality, value, and low volatility. So you get a portfolio of high quality companies with very durable balance sheets and stable cash flows. So I think all these ETFs are definitely worth a look if you want to invest like Warren Buffett. Any other closing thoughts, Tracy?
I would say about buying the S&P 500, Buffett has said many times that after he passes on, he expects that his wife, if she outlives him, obviously, would just be invested in the S&P 500, that she wouldn't, try anything fancier, and that it just works to go in the S&P 500. So I always use that kind of as a gauge of, where you might want to put some money.
Okay, we'll have to leave it there, but this was so much fun, Tracy. Thank you so much for joining us.
Thanks for having me. It is always great.
So let's recap the tickers that we discussed. So Tracy mentioned Fastenal, ticker symbol FAST. Mastech, ticker symbol is MTZ. United Rentals, the ticker symbol is URI. Then among the ETFs, we talked about AIRR. It is by First Trust American Industrial Renaissance ETF. We talked about the MOAT ETF, ticker symbol is MOAT. This is by VanEck Morningstar Wide MOAT ETF. And then the S&P 500 ETFs, we talked about 3 ETFs, one by Vanguard, VOO, the one by iShares is IVV, and the one by State Street is SPLG. And we also talked about QUS, that is by State Street, that is for quality. And in full disclosure, I own AIRR and QUS in the ETF investor portfolio that I manage. So Tracy hosts 2 weekly podcasts that you should definitely check out. They are Zach's Market Edge podcast and Zach's Value Investor podcast. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast, and also make sure to subscribe so that you do not miss any episode. And I'll see you next week. If you have any comments, questions, or suggestions, please email podcast@zax.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.